Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, September 18th, 2024. It's 11:44 a.m. Eastern Time as I'm starting the video, and it's kind of wait and see mode with the Federal Reserve today. So getting a little antsy. I figured I'd get one out to you. Just let me go over the things I'm looking at, what to expect, what to watch for. I've shared my thoughts pretty detailed lately, and at the end of the day, no matter which side of which way you think this thing's going to break, I think it would be hard to argue that there's not at least some type of coin toss element involved here. I'm going to start out here with the Fed funds future. So this morning when I give you the update, remember this has just been kind of all over the place lately. Up until recently, it was favoring a quarter point cut. Last week, we started seeing the odds for a 50 basis point cut ramp up pretty considerably into yesterday, about a 2/3 chance of a 50 basis point cut and only a 1/3 chance, or 33%, 35%. I checked it this morning when I got that post out to you. I started working that up about a little over an hour before the market opened, maybe an hour and a half. And I checked at the time, it was 65.35. And look what we've already done today. I've watched it steadily go down. And you can also see, no coincidence, that the market has tracked with this. So for whatever reason, maybe it was the new house starts. That's not a major economic report. Let me show you what I'm talking about here. Economic calendar, which you can access from resources. On the right side of the chart, go to resources and then to tools of the trade. I check this thing on a regular basis. That's all we had today. Housing starts right here. And those came in above expectations. So we had more housing starts. Actual was 1.356 million versus a consensus of 1.3. So not much, just a little bit above consensus. And so were the permits. Permits were a little higher. And you can contribute that to the cause because there's really no other market moving releases that were made today. Either way, it doesn't matter, but it meshes, at least in a very near term, if you want to look at it that way, as I am. It meshes with here's the QQQ, by the way. This is a 1 minute chart. This is this morning right here, and you can see a steady drop. Really, the steady drop started about 10:45 right here, and that's when I started noticing I kept refreshing the page for the Fed funds futures and the probabilities, and that's when that's dropped. So where I'm going is that meshes with my best guess is that, as I said in video yesterday, no bueno if we only get a quarter point. I think I know this market pretty well. I made a big call back in 2018, fourth quarter 2018. We shorted that was the biggest drop, and one of the biggest in decades, certainly the biggest quarterly drop in many, many years. We shorted it down, then covered the lows with impunity because I stated before it happened, the Fed would pivot. That the market, before that even happened, the charts were priced in. And here, if you don't remember when that was or what that was a big Q4 drop of 2018. Let me go back here if I can do it on a daily chart, turn off all the lines here and just show you that. And again, the takeaway was I got to go back to a little farther here, 2-day period, and that'll get me out to a 2018 right there. Nope, got to go a little farther. We'll go to a weekly chart, and that's fine. There we go. That'll certainly cover it. And that was it right here. And that was a drop of about, you can see as I measure here, roughly, if I grab the top of that candle, high to low, 23.5%. So technically its own bear market in QQQ if you go by the antiquated 20% drop definition. And so again, it was, there were 101 reasons. We had our, trend line breaks, plenty of evidence to short, which we did. And then coming into lows, which we covered, I stated you'd see a pivot. We went long Treasury bonds. We covered shorts, went long equities, and I said what would happen is the market would throw a hissy fit. This is when the last time the Fed, before this rate hiking cycle, they tried to get the market away from zero interest rates. and it started, a hiking cycle, and the market threw a hissy fit as predicted. And the Fed turned around just like a spoiled child crying for an ice cream sundae after dinner when it's time to go home. The market threw a hissy fit, and the spoiled parents, in this case Powell, gave the market what it wanted, and that was rate cuts, reverse course. And so stocks rallied, interest rates went down, bonds rallied, and that was that. So where I'm going is, bring it back to today. Let me jump back to where we are. Is that again? We'll see. No reason to bet it too heavy because this thing can go either way. But my best guess is that the market, because it has been expecting, at least recently by the federal funds futures, clearly telling us double the chance through this morning, literally through this morning, exactly twice the odds of a 50 basis point cut than a 25. That's already moved down a little bit. Maybe that's just traders last minute kind of covering their bets. Who knows? And who knows if I'll even be right. I'm not gonna bet things too heavy. I told you that. But we'll know. We'll let this market tell us what it thinks. And so I can just say, if you see the market dumping after the Fed, especially after Powell's comments on a quarter point cut today, that's probably going to be it. Remember, I've covered this quite a bit. This is the primary downtrend line off the highs. Most recently highlighted it as objective short entry and or to sell those longs. We went long here after reversing, after going short there. I mean, we've traded this thing down, with near impunity from the bigger, on the swing trades, and even some active trades in there. Short, long, short this down, and long up to here with highlighting this an objective level. Now, with that being said, and this is important, if you're just going to play odds and you're going to be just pure play, the odds still are better than the odds favor, not by so much right now, but they still favor a 50 basis point cut. I just refreshed the page; it hasn't moved, and we're getting down to the wire now. So, and that would say then, based on that logic, the odds favor. If that's right, the market will pop. See, the thing is, and the reason I think they'll probably give it a pop afterwards, and that's just my best guess. And again, a pop that's probably not going to take my guess, and I've said this, probably take this S&P 500 to new highs, but not QQQ. And most importantly, this all kind of dovetails in my trading plan and outlook hasn't changed or even deviated. We've gamed the counter trend bounces, but if you go back to late June, I had I'll move this histogram over. I wanted to show you that. I'll cover that later. I had before we got up there, the NASDAQ 100 topping in this range right here, this purple box. Box tool would be better. And which it did. It came, the futures almost made a perfect hit of my preferred, and I was leaning towards preferring move to the top of the zone because that would align with my Fibonacci's, line the Fibonacci retracements with my price targets. And so we pretty much got there within a spitting distance, as I like to say, 1.5% on QQQ, and virtually a perfect tag on the NASDAQ 100. I was going for ideal market top around 2100, and we hit within one fraction of 1% of that. So that's pretty much a perfect tag. Now, what didn't happen, and I covered this in yesterday's video, what did happen is we also hit right smack, split the crosshairs on my S&P 500 market topping range again from back in late June. And we hit it 1, 2. These are weekly candles, by the way, because I gave it to you originally in a weekly chart. That's why I'm showing it here. Look how many times we've hit it right dead smack in the middle. And so therefore, we could still make a new high in the S&P as long as we don't exceed my market top ranges on S&P and QQQ being my most important index, but this one certainly being important to many and to the market. I'm not going to ever downplay the importance of the S&P 500. Overall, it's probably a more important. It is a more important index for the U.S. stock market because it's much more representative with more sector, more representation of the entire stock market. even though it is not the entire stock market. It's only the 500 largest U.S.-based companies. So there's that. However, it's infinitely more diversified and representative of the whole stock market. It's QQQ. QQQ is just a better trading vehicle, in my opinion. It's going to go up and down more in percentage terms during the bull and bear trend. So if you're correct on the bull runs and correct on the bear runs, you're going to make more on QQQ. So why tie up as much capital in SPY? My same logic for trading silver and GDX usually over gold when I'm bullish on gold, because they move up in the same direction, just up and down more in percentage terms. So on SPY, that's it. So we could pop this range. As I said earlier, I think it's about 3% if we go up to the top of the range. And just to try to put it back in perspective, QQQ, remember, is still well below my market top range. So what would a 3% lift if we pop the downtrend line? Remember, this is what I'm focusing on and have been for the last few days. Here's your primary downtrend line. I'm going to measure it for you. I'm going to grab right where we are. We're right on the trend line now. 3% would just put us back towards the bottom of the range. Remember, we already had one back test of the range, which was highlighted recently at the time as an objective short entry. So we gained that, but it was very clear to cover shorts there and gain one more bounce up. And that's where we're at. So this is where, that's still my preferred scenario, but this doesn't change. Even this, as long as we don't exceed the top of that range, and ideally the top of the range on SPY. However, QQQ's got quite a bit to get there. So if QQQ gets to the top of the range, it's going to be an 8% rally, which will most likely throw SPY above the top of the range. So that's why I'm favoring. I'm completely very open to SPY pushing up towards the top of its range. QQQ already did that and rolled over, and so I think any move back into the range on QQQ would just be towards the bottom half of the range, with SPY maybe hitting the top. And all the better, guys. That's just if. That's if. And again, a lot of ifs here, but that's what will happen probably, or most. I'm not super going on anything right now. Well, I'm going to wait and see what the market tells me, what they think, what the Fed does. There's still that chance they could freak out on a 50 basis point cut, especially the institutions, the professionals, saying, what is it the Fed sees? Do they see a problem somewhere with a major financial institution, something we don't know about? Because all the data out there right now is kind of mixed bag stuff. We see the trend in the employment market. That's probably the biggest focus right now for the Fed and everyone else. But, the Fed has eyes on things that we don't. They're privy to certain things that the general public isn't. So, all right, that's it. And then after today, especially after the press conference, I'll decide when and how to re-engage the market and where to, if anything, where to, modify my trading plan. In other words, where do I start stopping out? I'm kind of putting, like I told you, suspending for the most part stops, but I also don't have a lot to risk. The risks are too binary right now for me to bet it hard one way or the other. I would rather see, what I'd like to see is a quarter point cut with the market really getting upset, throwing its little tissy fit, giving me an impulsive rejection here. Let me shoot back down to the 60-minute charts. Here's the 60-minute chart, which we've been nabbing with really, with impunity, swinging these trends, shorting, going long for bounces, shorting again, long for bounces off support, which is, I've moved the lines here. I had it on the futures. I have so many levels, I'm going to just pull that back down there. Okay, so that would be, to me, an ideal scenario where to start. If you get a pretty big rejection, my thoughts, I've stated repeatedly, I think a break really under these recent lows right here, where we reversed, covered shorts and went long from the short off there. I think that will most likely open the door for a move down that'll probably just shoot right by there. A lot of traders are going to be focused on that previous reaction low, but I've shared my thoughts. I think we'll bypass it most likely. And if it goes the other way, well, I already just spent the first part of the video showing you where I think QQQ is likely to bounce and SPY. So roughly, SPY has about 3% upside. Give it maybe 4 on QQQ. It's a little more, a little higher beta, and so that might put us up here somewhere. What would 4% do if we pop the trend line? That'd be about, be right here, and there's a gap right there. And so really anything above that gap is where I give you that, I was talking about escape velocity when we were coming up before, when we were rallying up here, where the market would most likely reach escape velocity. And that's the term I'm using in the stock market, where it gets near a new high and it just really breaks free of the gravitational forces. In other words, resistance, where just like, the term comes from, aeronautics or aerospace, where, a rocket, that's once it's clear of the Earth's gravity and it no longer needs thrust to get to escape the Earth's atmosphere. So that's the same kind of thing there. And it's that gap right there. It's about 495. That's escape velocity. And that's also going to have punched it up there and probably taken SPY above my range. It'll still keep QQQ in my market top range. And as you've heard me say once, and you've heard me say 1,000 times, the charts are dynamic, and so is my analysis. So if that happens, this is still my preferred scenario. As I mentioned multiple times, just like I did back here, it's objective to short at this trend line. Now, the thing is, it's a little fuzzy on where your stop's going to be. If you want a tight stop, it's going to protect you from, if this market just blasts off to new highs and beyond. That's what a tight stop will do, limit your losses. A little more liberal stop, like I'm leaning towards right here, and much prefer on swing positions. If you are on the same page with me, if you're targeting any of my deeper targets down here, I still maintain T7 is current final target, with additional targets likely to be added if and when we get down there. I also maintain that, if we do get rejected off here and do take out the recent lows, we'll probably have very little. It is still the next target, so it's an area where reaction's likely, but we could go on right down through there and hit T4. But it's also going to be, remember, it's not just a price target. It is, but it also lines up with that 38.2 Fibonacci retracement level, like most of my price targets do. T4 aligns with the 50% fib. If you're new to the site, what I'm talking about is the entire bull run off the October 2022 lows to the 2022 highs. I use these fibs. I first laid out my price targets where, from experience, where I figured how this thing would unwind, going down, hitting the targets, reactions on the initial tag each one. That's where I give you now just usually arrow breaks. And then I added the fibs on there. And again, I use that to help calculate those targets as well. And so we'll see. Speaking of which, if you do trade the NASDAQ 100 futures, I had to annotate the chart on this particular platform that I'm using. I initially gave it to you on the previous contracts. Those targets were laid out in late June. Stock index futures roll. They roll on a quarterly basis. So the December is now the most liquid contract right now. And the current, what we call the continuous contract. And so the levels, I wanted to note that, and I did right here. If you'll notice from here, I'll show you. Here's the last update when we hit actually that was during T4. I just used this. So these previous charts, remember, we hit T6 to the button. That's when we reversed. Here, you can see it here. So that was the morning of August 5th. We'll go down in history as a significant major bottom in the market, inflection point. Did a hard stop, covered all shorts, went full long, and bounces were to be determined. That was, again, as we were within 1 point of the, and so back then that was 17,352 is where I had it. And remember, when the futures roll, the futures are different from the spot index, the spot NASDAQ 100. So the levels are going to change with each contract, and that's what it did. So T6 now, which was already, no, that's the old one. Let me get rid of this guy. Here it is. These are the updated. T6 is now at 75.50, and it already got hit. That's where we reversed right there. And we went up, we hit there. There was a downtrend line. Back then we did. It wasn't even. We did. We had the early makings of a downtrend line, I believe, on the 60-minute charts. But either way, that was a pullback. And see, it's bouncing. These were the same levels. I just replicated it, the same reaction points. If you're wondering how I come up with the targets, if you study the old charts, you'll see all the lines are at the same price points. I look at the candlestick bodies and wicks and to determine my support and resistance levels. And so you can see just how well, and that's what the market does. My style of technical analysis especially on the indexes, which can be harder, a lot harder to trade than individual stocks and securities. That's why I love trading futures, commodities. I think we're like at least 3 for 3, if not 5 for 5 or more on crude. Today, another 6% gain. We've had, the last few, if you go back, we're with impunity. We hit the lows, or this one was a breakout after the lows, but it was, the previous one was at the lows, sold right at the highs, final target, get out. And so, we've made, just the last 3 alone, we've made more on just trading crude oil, if you look at those last few trades, than what the NASDAQ's done in, I think it's a total of about 16, 18%. There were small little short-term trades, about 6, 7%. And here's the NASDAQ 100. If you look at where it ended the year, there's the last trading day of last year. So for those that think the market's screaming, we're only up 15%. We've made more than 15% cumulative on just the last 3 trades trading crude. And that's why I like to spread around. Now, the thing about the markets, what can make it tough normally is that they call it the passive bid, especially in recent years when they made the legislative changes or, changes, industry-wide changes that forced auto participation in a lot of 401k plans, where in the past people would sign up, get a job, and if they didn't elect otherwise, they weren't in a 401k. So now you just have constant money flowing into it, and it's really changed the dynamic of the market. However, when old Mr. VIX goes up, when volatility starts to spike up, that's when technical analysis shines. VIX tends to spike up when the technicals, when the market starts to break down, when the technicals finally, those divergences of build. Remember, divergences and overbought conditions are not a sell signal. What are breaks of support, be it price support, key moving averages, uptrend lines, bearish chart patterns, and then you get the volatility spike, and that's where I'm going. That's when technical analysis, especially on the indexes, tends to shine. So again, when you get these levels, calling it down to the 200-day moving averages, hit the 200, we're going to bounce. There's bearish engulfing candles, sell signals to get us down there. And we're still at the VIX has come down, but it's still elevated, and this also tends to coincide with divergences in the outlook of the macro picture. In other words, the economic outlook. So right now, like I told you, you can make a good case if you are bullish, and you tell me, Randy, sit here and make a 20-minute, 30-minute video or an hour of why the economy is strong and bullish going forward, and we're going to see new highs in the market and no recession. I can do it. There's a lot of indicators that, one of them that I'm watching that's just not fitting into the piece of the puzzle yet. For a much bigger drop down is credit spreads. Now, I believe the credit spreads are, I don't want to use hyperbole, but I would say dangerously low. They're not pricing in. They're pricing in virtually zero risk. And that sets the stage for crash type scenarios. Either way, what I can tell you, and again, that's normally you'd see credit spreads ticking up if the economy was about to roll over. But what I can tell you, the VIX is elevated. You can see it's been making these higher highs. This is the VIX since July. We had that first spike. And I think that may be the shot across the bow. If my price targets on the index, my outlook play out, be it whether or not we get a quarter point or 50 basis point cut. We know we're getting one or the other. That doesn't really matter at the end of the day. If the market doesn't like whatever it gets, then you can see, the VIX really, really spike up. And again, I wanted to point out that it's elevated, and back to where I was going with that, it has to do with how well my style technical analysis will shine during those periods, being able to navigate such volatility when most people are losing their heads. So now at this point, like I said, I have to say, it's a key inflection point. If they pop this trend line, and if there's going to be a catalyst ever, it's going to be today, most likely, what the Fed does. Then I already gave you where we could go. Now, we're still well off the highs in the NASDAQ, so I'm not fearing or expecting new highs in the NASDAQ. Like I said, the S&P, we pop these trend lines. That's probably going to happen in the S&P. It's not far from it. but not in the NASDAQ. So, and you can also see, remember that support, all these were levels laid out before the market even peaked. They were laid out the day before. I gave you this, not in June, but a little after I gave you the targets on SPY and QQQ. But I did give you this literally the day before we peaked. And they were support levels, they were targets, all of which were hit. You can see we had reactions off there. There was T1 hit, we bounced. T2 hit, we bounced. T3 hit, we went down to T4 and then we bounced. T5 was hit, we consolidated on the daily chart for a day or two there, and then T6 was hit and we had a hell of a bounce, right? And you can see the selling started to accelerate, and that's something also that I do. I'll just give you targets, I give you my thoughts on how we're likely to act as we hit each target. And I've already shared with you that I'm 50-50 whether we're going to have much, if any, of reaction on T7. And currently, again, I'm talking 5 steps ahead, guys. We haven't even gotten done with the Fed yet. We haven't even ruled out this or anything higher yet. But if it plays out the way I think it will, T5 is a magic number. Remember, these levels have not been added in hindsight. They were there before. So where I'm going with that is the same levels, support once broken becomes resistance. So when we rallied off T6, remember I just showed you that chart a minute ago, my targets were expected to bounce. It was very firm on that, covering positions, but with the bounce targets to be determined. That was that morning, right when we were right there. And you can see we rallied back to basically a slight overshoot of T2, just like when we bounced off T4, we rallied right back to T2. And so, and then just recently on this drop down, where did we stop? T5. We never really had much reaction, but it was still good support. There was just waterfall selling right now, and that sometimes happens when there's a strong, momentum going into a market. You're going to overshoot, and it's also what I called, you've heard me use this term, I make a lot of terms up, a momentum-fueled overshoot. And that's when you have a lot of velocity heading up in a bull trend or down in a sell-off. A lot of velocity, you tend to overshoot the support level, which would normally hold, and then snap back above it. And the analogy I always uses a pitcher throwing a 90-plus mile-an-hour fastball, hits the catcher's glove, it does not stop right there. If you slow-mo that video, you're going to see his wrist snap back and then spring back forward to the position of so that's what that was. We overshot, we hit my next target, which was an even better level to cover, deeply oversold for all the reasons, and we reversed. Tons of stocks hitting their price targets at the same time, and 200-day moving averages, and the S&P hitting the 200-day moving averages, and et cetera, et cetera, et cetera. So now we've already checked T5. We checked it again. It opens the door that we go on down through there, and if we do, T6 has already been checked. That's why I think we'll waterfall right past T6, where a lot of it's still massive support. And again, let me reiterate this. If I thought I laid this out back when we were right here, the fact that we had such a distinct and powerful explosive reaction off it further validates it. So for those that couldn't see it back here in the charts, they see it now. It's the most obvious level there is in the stock market at this point in time, other than maybe these downtrend lines, right, or the previous highs. So that's a big level. A lot of eyes are going to be on. A lot of Pavlov's dogs, i.e. dip buyers, will look to be buying it there, but we've already checked it. And that doesn't mean we can't bounce. If we get there, it doesn't mean we can't bounce and explode off it again. It just means the way my price targets work is typically I expect a reaction. Those levels are laid out in advance because a reaction is likely upon the initial tag. Once that initial tag has been made, it increases the odds that the next time we get there, even though you could have 1 or 10 more reactions, it increases the odds that level will break. If my outlook's still bearish, sometimes that's where I hard reverse and stay short long, for the next move up. But you can see so far we have lower highs in the indexes, and if we take out that former T6 level, we're going to have then a new lower low, and now it's going to become apparent to the masses that we have all the makings of a new intermediate, more powerful, longer-term downtrend. Right now, you can't really. You could sit here and argue whatever point you want, but you can't make a solid case that wasn't anything more than just a correction in an ongoing bull market, because my longer-term uptrend lines, even the 200 days, which I was calling for a pullback to and a bounce, they weren't taken out. You take out the 200s, you got something else going on, especially if you take them out on a solid weekly closing basis. And remember, if we take out T6, which was where we recently reversed on the NASDAQ 100 and S&P 500, more for a lot of folks watching the S&P, remember, intraday we were down there to the 200s. And so if we take out those recent lows right here, in the S&P, there's the 200-day moving averages. You're going to have taken them out there. Same thing with QQQ. If you take out the recent low, which again, you got to go here to this chart, T2. Remember, we used the futures to cover there in the morning. We were actually probably closer to T3. We will have taken out the 200-day moving averages. This is a weekly chart, but they're the 200-day / 40-week moving averages. And let me just show you without everything. And they just do a bang-up job. Again, I do this because I know there's new folks coming on the site. They define bull and bear trends. In a bull trend, you want to buy pullbacks to the 200s. That's your MO. When you're below the 200, there's COVID. You're in a bear market. It was a bear market. It was quick. Fed didn't allow it. Would have been a lot bigger had they not come in with extreme measures. But boom, you broke it. You back-tested, and you were in a bear market. You broke out. Bullish. Then you back test it successfully. So once you go above them, and you're clearly above them, you buy pullbacks to them, you buy pullbacks to them, you buy pullbacks to them, which we did. Then once you break them, especially this is a weekly chart, you get a weekly close, solid weekly close. The farther away you get, the more likely it is it's not going to be a whipsaw. That, by the way, wasn't a whipsaw. That's a weekly candle. I'm sorry, it was. We closed, one day below, but remember, at the same time, that's why I take everything collectively. The S&P 500 and many of the market-leading stocks had successfully tested and bounced off or recovered back above their 200-day moving averages. Okay, so we'll get away from the stock market. In summary, it's certainly, I view it as somewhat of a crapshoot, and I don't like to lay heavy bets on crapshoot odds. I like stacked odds in my favor. I'm going to update Treasury bonds and tell you what to watch for there. I still very much like TLT and ZB. These are ZB, the futures. I first highlighted here with a break. Sell signal coming a break of that uptrend, minor uptrend line. Shortly after, I added a secondary uptrend line here, which actually has as many or more reactions. We bounced off that, and then that one broke down. And so I still maintain very much like this trade, and I'm open to even longer, deeper targets in this. Those are the targets I gave you: 1, 2, 3, T4, and then TLT is the ETF if you don't trade futures. Big divergence on the daily chart here. Negative divergence on the daily, just like you had big pods. The last time we had divergence on the daily that I highlighted was back here on that divergent low. We went long. I gave you a couple of targets, which were hit. Biggest move in Treasury in years. We caught that low. We were short off the highs here. And so that is a big factor there. We don't get these divergences quite very often on the daily chart. This is what it looks like on the 60-minute chart. That's the trend line I gave you with the sell signal. We put in an ever so slightly marginal new and still divergent high. And we also hit that BOD, benefit of the doubt, support a first target there, bounced as expected. We're back there now, 99.96. We take that out. We're going to go down. I'm still favoring a move down to this uptrend line right here at minimum. Remember, this is the 30-year bond. When you look at TYX, which flipped the 30-year bond upside down, and look at the 30-year interest rate on the 30-year bond, it's going to be the opposite because bond prices move inversely to the yields. The big positive divergence here on the 60-minute chart, and again, this is the first time I've seen divergence, positive or negative, in a while. Last time we had negative divergence there. That's where we went long with almost perfect entry. The lows on Treasury bonds there. We milked the biggest drop in yields, which was the biggest bond rally in quite some time, and then we've come full circle. That's it. So therefore, we could see, and you might be wondering, well, Randy, that makes no sense when you just said we're certainly going to get a rate cut. Well, you have to ask yourself. Remember, this is yields. How much of that? Obviously, the odds have been moving up significantly in recent months. So how much of this 20% drop in yields here from, where were we at on that? We were at 4.8, over 4.8 on the 30-year. Now we're down to 3.9. How much of that's been priced in? You can argue, the market will tell you, but I'm going to say most, if not all of it. There is support down below. I'm going to move this line right here up now. I see a better support level right here. So if we drift a little lower, there's support. You might consider a stop. I'm viewing this as a longer term swing trade. And so a stop under that 338 level on TAYX, which is about 3.8% yield on the 30-year bond. But we already have some sell signals, and again, this could be a trend that could take us up. I'll keep updating the trade. I just want to let you know that, and remember, the Fed, what they're going to cut today is the federal funds rate. The federal funds rate is a rate at which banks loan money to each other for overnight, literally overnight lending rate, not a week, not 2 days, overnight. It's the shortest of short-term rates there is. This is about the longest. U.S. only issues out to 30-year bonds and has for a while now. So this is the polar opposite, and it's not. The Fed doesn't control this rate. They don't set this rate. They can try their best to manipulate it in conjunction with the Treasury due to issuance of Treasury bonds or Fed using quantitative easing. But at the end of the day, these rates are set by market forces. And, I can sit here and I don't want to get into it now, but I can talk fundamentally about why we could see interest rates just really start to run away, and it would be crippling to the economy. And most part is, whichever candidate gets in office, they're both budget busters. So they're both, big spending programs going to coming up, and we're already at huge debt to GDP ratios, biggest in non-wartime we've seen in a long time. So there's just no room. We won't be able to finance. So there will be, especially if yields, bond yields go up, continue to go up, no matter what Fed does on the short end, there's going to be at some point a crisis. This is the path we're on is unsustainable. And the thing about it, you might say, yeah, Randy, you and others have been saying that the bond vigilantes are going to come after the market, blah, blah, blah. And you know what? These things, and history shows, it's never a problem until it is, and there's usually just a flashpoint. And when things like this unwind, it unwinds quickly. And you're going to see institutions and other governments just refuse to buy our bonds at some point. So let's not get that far ahead of it. That's fundamental stuff, and it's long term. This is near term. More importantly, is how we zeroed in on the 60-minute charts. I just wanted to kind of update that trade for you and say what may happen here, because we know we're going to get a rate cut. And like any trade, guys, any trade, it either works out or it doesn't. Don't get married to it. Have your stops somewhat above based on your price targets. A little bigger your price target, the wider you can give a stop. I gave you some levels a minute ago, some key technical levels to watch. So let me wrap it up here. We'll watch things like the semis, SOXX, also at downtrend line resistance. As I mentioned the other day, beautiful downtrend line off the highs. So this is the story of just about everything. You've got the indexes, SPY, QQQ, the most important sectors, SOXX, at downtrend line resistance. Just waiting to pop and run, and they may very well do that. And if they do, I like the stock market until and unless I see this undone, these bearish engulfing candles back here, divergent high. There was amount evidence of a major top. Traded it, we covered it where we should have, right on the uptrend line. That was August 5th. We covered everything, went long. So again, trading this with impunity. I highlighted as an objective short entry or re-entry here, along with NVDA the other day at that shorting zone, new short zone. This box, look at that. So far rejected off the bottom of that level right there. And should it rally post-Fed? Nothing's changed. My trading plan, if it changes, I'll let you know. It remains a scale-in zone. Like I said, I will wait and see. If we pop the downtrend lines on SOXX and SPY and QQQ and everything today, I'm not going to jump in as aggressively as if we get, if they only give us a quarter point and we crap out. At that point, I might be quicker to add back a full short exposure than if we pop above. Because like I said, I gave you kind of a zone in the markets, in a zone in NVIDIA, and even on the SOXX, if you want to look at it that way. I didn't give it a zone, but I'll tell you, it's going to be, actually, I'll take this back. We have a resistance level right here. That's the wrong tool. Looking for a horizontal line right there. You can see recent highs, reaction there, gap right there, resistance, support. So here are your resistance levels. I would have to pull this line down. That was just an older line. That was an important level. We broke down here, back tested, and then we took that out. I'm going to move that line right there. So you can see these are your nearby right here, up to about 242. Call this a objective short reentry zone or scaling or add-on, however you want to call it. And if you're bullish, you want to see 242 get taken out. I think that's like I said, that level is probably should remain there. Ideally, for the longer term bearish case, if we go on to back test it. So above here is where things start to look like maybe the semis might go on and pop that previous high. Until then, nothing has changed, and I'm viewing this as a likely top, and we're in a counter trend bounce now that will be dependent if it's got any more juice left in it or not. We'll know today, or later today, and tomorrow. And then next week, if there is a post-Fed rally, my expectation it'll fizzle out within by next week, probably. I guess by the end of next week. That could be as early as tomorrow, or as late as next Friday. And that's just my guess right now. We'll see. I'll see what happens the rest of the day. I'm going to wrap it up here, get the video out to you guys, and I will give you my thoughts after Powell's press conference today. So that'll be, before the close, sometime out between, 3:30. I'll get something out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.